What do insurance companies and casinos have in common, or what do they do that's similar? They make money based on high probability betting. So what we want to do is we want to become like the insurance company or like the casino in this particular strategy. And we want to employ high probability betting using what are called deep out of the money put options, as I'll explain. So first, let me talk about the strengths and weaknesses. The strengths are that it has a high probability of a return. It's not correlated to the market, it's simply based on probability and odds. And it has a high return potential. But the weakness is there's also potential for very large, rapid, like overnight type losses. So we don't want to put typically more than about 20% of the client's portfolio into something like this. So we've already talked about options, puts, and calls in the previous video. So now that you've got a basic understanding of that, this will make more sense as I go through how this high probability option strategy works. So let's say that this red line is a market index. We'll make that be the S&P 500 index. I'll abbreviate that with ticker symbol SPX. And this point in space would be some date in time. Let's make that August 11th. And the length of time here from point A, let's call that point A, to point B, which is over here, let's make that about 3 weeks in time. So let's say that's August 30th. So this is typically a 3-week or so trade length. And we want to know with a 90% probability, which is what the dashed cone is supposed to represent, we want to know with a 90% probability the range in which that market index might move over that short period of time. So maybe it'll go up or down or sideways. We want to know with a 90% probability where it might move. Once we know that probability range, then we're going to go well below the bottom of the cone where we would expect the market to be able to move in that period of time, and we're going to sell a put option. A put option is like an insurance contract against a falling market. So when we sell a put option, we're selling this insurance coverage to the buyer that covers the buyer only if the market drops from here all the way to below here in that length of time, which we know is highly unlikely, right? Because we know there's only a 10% chance that we'll be out or below the bottom of this cone by that date, and we've gone a standard deviation or two below that cone. So we know there's realistically only about a 2% or less chance of going below this value before this date arrives. So the buyer is going to pay us premium for that protection, even though they know that we've got a very high probability of keeping those premium dollars. Why would they do that? For the same reason that you pay premium to your insurance company on, for example, your house, because you need the protection and it's relatively cheap compared to the risk that you would have if you didn't buy that policy. Or like a gambler, the gambler knows the odds are against him, but yet he believes there's a chance that he could make a larger return. So we sell this put option, we collect premium for it, and then we hedge our bet here. In the unlikely event that this goes bad, we reinsure this position by buying a put option. When we're the buyer, we're the insured party. So we pay premium to buy this protection, which puts a floor underneath our maximum loss potential. Therefore, the premium on the option that we're buying is cheaper than the premium of the option that we're collecting premium on. So $3 signs in, $2 signs out is a spread or a profit created for us. And this spread is designed to be 2 to 4% per trade. The trade length, as I previously explained, is only about 3 weeks. So 2 to 4% per month is a good way to approximate the return expectation. So we expect we're going to make 2 to 4% a month, which is 24 to 48% per year, whether the market goes up, down, or sideways.